morning, folks. This is Naeem Aslam, Chief Market Analyst at AvaTrade, and happy Friday to you all. When we look at the stock market, one thing becomes very clear, and that is this stock market is addicted to quantitative easing. And by that, what I mean is the support from the Federal Reserve, the support from the central banks around the globe as well. Now, yesterday, the Federal Reserve came up with its new monetary policy framework. Now, under that framework, the Federal Reserve is going to target average inflation of 2%. Now, what does that mean? Or in layman terms, that means rates are likely to stay lower for a longer. And I'm referring to interest rates, because it is these interest rates that the Fed lowered them very quickly when the pandemic hit the market back in March. The Fed started to lower the interest rate, and they are sitting at a record low level. Now, given the fact that the Fed isn't going to change its monetary policy for at least another 5 years, it seems like that these rates are going to be staying here for a much longer period of time, because the Fed has said yesterday, look, we understand that there is an economic recovery in the market, which is better than the current anticipation as well. But the Fed said that the damage which has happened to the economy and the millions of Americans that are out of job in the travel sector, they are unlikely to get back anytime soon, especially not overnight. And this particular aspect has really put the market in a very much of a Goldilocks scenario. Now, what do I mean by that? The Goldilocks scenario means that any news that stipulates or that indicates that the stock market or the economic data is still very much weak and the economic recovery is still very fragile, investors and traders are going to take that news as negative news is a positive news. Why? Because for them, that will be a further confirmation that the Federal Reserve is going to maintain its dovish monetary policy stance for a longer period of time. Now, on the other hand, if the economic numbers start to print a reading which is better than the anticipation, then they also know, these stock traders and investors, they know that the Fed is okay with running the economy running a little bit more hotter, because they are not worried about employment and inflation overshooting their target, meaning economy running a little bit more hotter than what the anticipations could be. So that means that, okay, good news is good news, and that will continue to stimulate the current coronavirus stock market rally that we are experiencing. Now, in terms of today's price action, as you can see, the Dow Jones Index has inched even more closer towards its all-time high. Yesterday, it briefly became positive and it erased all the losses for the year. As for the S&P 500 index, it made another record high yesterday, and the index is still very much maintaining its upward trend. That's all for today, and see you guys next time, folks.